Well, CNBC parent company Comcast announcing a brand new streaming bundle early this morning that will include Peacock, Netflix, and Apple TV Plus that will launch this month at a vastly reduced price, according to CEO Brian Roberts. The news coming as Lionsgate Studios opens its first day of trading on the Nasdaq under the ticker LION, Lion, after completing its spinoff from Lionsgate Entertainment. The SPAC spinoff creates one of the largest pure-play content companies in the world, its film division grossing over $1 billion at the global box office in 2023. Joining us now is Lionsgate Vice Chair Michael Burns. Michael, welcome back to Fast. Always great to see you.
Compliment.
All right,
Happy to be back. I feel like I'm coming home.
So, reminder viewers, basically this isolates the assets. It takes stars away, so you can actually get a pure play valuation.
We took two significant steps in the last week or so. We split the bonds, so on full separation, we'll have about call it half of our bonds that'll end up at the studio and half will remain at Stars. We just closed 13%, a sale of 13% of the studio on this deal. And then our plan is before the end of the calendar year to spin the rest of the stock so that 100% of the studio will trade.
Okay. What is the environment like now in terms of the demand for content? I mean, the demand for content is always there. It's just how much companies, platforms are able and willing to spend at this point. I mean, we've seen so many companies out there, they're having difficulty reaching profitability. They're now bundling, sort of going back to the days of cable where you can get a bunch of channels in one package. What is that environment now?
Well, we like the fact that people are spending a lot of money on content. We're separating the businesses because we think we're going to get two different multiples, one for Stars and one for the studio. But remember, we're the benevolent arms dealers. So we will license our product to anyone for the right price and if it's the right home for it. So we like the fact that budgets are increasing on content spend. We like the fact that I call it the Suits effect that library product did so well for Netflix, for that matter. And we're seeing a very competitive marketplace. Our television people, led by Kevin Beggs and Sandra Stern, they're going to have a very competitive process for a television series are out right now. We're just finishing up filming for this Apple show with Seth Rogen playing a studio executive. It's pretty damn funny. So as long as you have great content, and we're pretty good at that, you have a competitive marketplace.
So speaking of that competitive marketplace, what does the Paramount feeding frenzy mean for your assets in terms of benchmarking and whatnot? It's a fascinating time. I kind of feel that having very smart media-focused private equity in the room suddenly means there's people that understand intrinsic value.
Well, I like the comp because I like what we're earning in our content business. We're projecting that we put out there in the documentation and the registration statement in fiscal 25, which we're in right now. We're expecting $430 million of adjusted OIBDA. We've been around long enough that we certainly, when we put a number out there, we're not going to miss it. I will tell you that when I look at the Paramount situation, to me, it's a great example why I really don't want two different classes of stock. And what we're doing on the studio spin is we have one class of stock in the studio. And ultimately, when we combine, when we spend the rest of it, the plan is to have one class of stock.
That was going to be my question. See, that leads to my question. In retrospect, do you think the investment community had a hard time understanding LGFA from B, and this will be more of a pure play that people can wrap their hands around?
I think simplicity is a good thing. Obviously, our shareholders are going to have to determine what the ratio is, the A's and the B's, when we fold it into one class of stock, and there'll be a shareholder vote on that. But I think simplicity is a good thing. And I think the idea of keeping it really clean, which we're doing with the content business on one side and Stars on the other side, I think simplicity in this marketplace is a smart thing to do.
You mentioned the studio business and creating new content, but there's also the library side. And you also had mentioned the Suits effect. And so assets that are in the library, maybe mothballed for however long, can find new life on various platforms. So how much is that worth now?
It's funny. I'm sure I'm going to give my Associate General Counsel a heart attack when I say this because it'd be...
we won't tell anybody.
But I will, exactly. Let's assume for a second you're widely disseminated. But our library, when we report our quarter in our library, which is ending March 31st, it'll be a record quarter and it'll start with a 3. That's a phenomenal number. So the Suits effect, the idea that we have all of this library product coming back to us, we don't license them for long term. For example, in the fall, Mad Men will be coming back to us, and I'm sure that'll be an interesting bidding situation for that. So we like the idea that we have 20-some thousand titles, call it $800-900 million in revenue, very high margin business. It's worth a lot. And it gives us the ability to borrow money at a very cost-efficient manner, which is a giant barrier to entry. So without the library, one of the smartest things that John and I did is that we made some dumb decisions too, but one of the smartest things that we did was we bought every possible library. We've done all these acquisitions. There are creative transactions, like, for example, E1, which pushed off what we just did a little bit, but it was worth it.